afternoon. Welcome to Chicago Future of Finance. I'm Oliver Rennick. Stocks right now a little changed. S&P 500 slightly higher. VIX a little bit down. Kind of feels like something's brewing here in the middle of the week. The order of events over the last week basically went like this. There's a few things I've been watching. Firstly, it was crypto that softened up. BTC pulled back. MicroStrategy had several weeks of losses. That high beta, high intensity growth trade in crypto softened up despite some of the miners that we talked about yesterday looking pretty good. And then after making all-time highs, the stock market took a little bit of a hit with Nvidia fading post-earnings. Numbers that seemed to be adequate and still showed a lot of AI growth and power in that major thematic trade. But semis aren't bouncing back today. Right now you got chips down on the session. NASDAQ's up a little bit. But after Nvidia pulling back post-earnings, that group really needs to find some support, and it hasn't. The other thing today that stands out, and this is the third thing that is ticking a little bit in my spidey senses, is that gold's going absolutely ballistic. Gold's move is huge. Gold's been green on my risk radar basically forever because it seems to work in just about every scenario. But it's important to note that arguably it does offer something a little bit less risk on than a few of the other juicy, frothy trades we were getting earlier in the year. It doesn't mean people are rushing to buy bonds. It doesn't look like there's any kind of risk off necessarily just yet, but that's the stage that's set here. We got a great show coming up. We'll be talking about some of these things. My guests today offer a variety of outlooks and expertises. We're going to be joined by Brent Kochuba off the top here to look at the intraday session. Joel Hawthorne joins me. Looking forward to that conversation, a longtime source of mine here in Chicago, and the definition of how trading can be a livelihood and take you to where you want it to professionally and personally. That'll be a fun conversation. Pete Najarian joins us to talk some fun stuff on the gamble today. We are going to make sure to hit that and talk about some of the unusual options activity happening around stocks, looking at Tesla. We're also going to be looking at silver and gold. And then we're going to go into Kalshi to look at some cultural and some sports stuff. Pete's got a few sports ideas on the NFL side that we're going to take a look at. And I've got a few cultural and political items that we're going to look at some wagers on as well. Then we're going to get very technical and very mathematical with the great Petra Bakosova joining us from Hold Tactical, another longtime source of mine in Chicago, whose ETF just passed $100 million earlier this year. And that is no easy task, especially when up against some very serious competition in the world of equity hedging and options-driven funds. Scott Bauer is going to round it out with us for the Risk Radar. We'll talk some gold there too and look at one of his favorite trades as well. Right now, let's bring in Brent. Let's go to SpotGamma, and as always, scan the QR code for a free pass at the Flows report. So Brent, the thing that stands out to me is that we're not risk off, I don't think, by any definition really. Like we just put in all-time highs, but around the edges, some of this stuff is getting interesting because we lost Master, we lost Bitcoin over the last 2 weeks, and it kind of looks like maybe we're losing some of the Nvidia trade here again with no bounce back today in the semis. What do you make of that?
Yeah, to your point, there's a lot of churning here, and Bears had the opportunity yesterday, and what did they choose to do? They chose to sell their protection, right? So if you made money on puts, if you made money on VIX calls yesterday, you monetize those positions. As evidence of that, download that Flow Patrol report, scan that QR code, you'll see all those trades. You're also going to see some gold rolling exposure. So we saw some pretty big hedges in GDX, for example, some put hedges that went up and some calls getting rolled in gold as well. So that is one asset that's on fire. And I think what is saving the market today is Google. Google is on a lot of people's radars because it's up 7% today. Google is 5% of the S&P 500. So that's adding about 35 basis points.
Because of the ruling.
That's right. And there's a lot of really big options trades tied to that. Google is just kind of ripping here today, doing really nicely. So that is the one sort of tech space that is strong. I think some assets are clearly flowing to that, just judged on the sheer side, judging by the sheer size, of trades here, call trades. So, that is helping the bull side here. But to your point, the semi trade for all intents and purposes at the moment is kind of dead, and I don't know, what necessarily restarts that. Now, just as we say that, we see, small caps kind of struggling a little bit here as well. So I think that the market needs a little bit of leadership. And as much as we thought the economic data didn't matter What we see now is that implied vols are generally pretty low, which again backs your point about risks not being all that heavy at the moment. NFP on Friday is really getting a pretty sizable volatility bid to it right now. We look at 15%, nearly 16% at the money implied vol for Friday, which shows you that we're really watching that NFP report. And if that NFP report doesn't matter, then I think we kind of go back up to all-time highs. But just as people didn't want to hold on to those downside hedges yesterday and monetized everything, they're also not piling into bids here to counter any of that off.
Right.
So we're
That's
really
a good
stuck in the
point.
middle.
It's more of like a lack of big upside appetite rather than it is, bears regaining some control. If we go into SpotGamma and look at I want to start with the scanner again, that quadrant of volatility and IV rank, because you can see gold over here versus NVIDIA and S&Ps and Qs over here. So they're not polar opposites, right? But they are very much in a different place volatility wise. So kind of rehashing that difference of where there is appetite, there seems to be so much of it for gold. And, I'm not someone who really thinks gold is necessarily a risk off thing, but it is more towards that camp than obviously an NVIDIA, Master, iBit, or some of the stuff we've got over here in the cheap vol with upside potential category.
Yeah. And, right now, gold is the only thing that seems to really be having that consistent bid. Now, the higher we go on that grid, the more vertical we go, I think the more you got to be concerned that we're overbought. I'm expecting tomorrow we probably enter sort of an overbought condition, which is just people, there's a lot of momentum traders. So there's the fundamental macro idea of, hey, we should buy gold because of, whatever uncertainty you're trying to hedge or whatever the dynamics are. And then there's the momentum traders, right? And the momentum traders will tend to shift things into overbought category, right? And so if that implied vol rank moves up just a little bit higher, then I suspect that we'll see a short-term top in gold. The performance has been unbelievable. I'm not trying to say it's an all-time top, but, look, we could see a high, put in a high that lasts for a couple of weeks if that implied vol just shifts a little bit higher. And again, today I suspect that'll be the case. Now, in regard to that cheap downside, it's very cheap to buy QQQ calls, spider calls, whatever it may be. So even if you don't like that upside, buying calls or call spreads at the moment, quite cheap. You could also say that about the downside, right? Like that implied vol is still pretty cheap. Yes, puts are expensive relative to calls, which is why those dots show up on the left. But I would suggest, hey, look, put spreads solves your downside concern. Calls are really great for your upside concern. And so it's really quite cheap to play in the option sandbox right now.
So that's important, because if you still have an optimistic bias, then it's pretty cheap to buy the upside on the tech stuff. Whereas it also speaks to the conviction in gold, by the way, because it's expensive to get upside in gold right now.
Yeah, 100%. And if you go to the tape, which is one icon above there, I just want to show you some of the big trades going on today. So just scroll up one. There you go.
Yep, got
it. And open that trade. And this is showing you the sum of trades and individual largest trades on the day. And look at that on the left. You see GLD putting up 1.1 million calls today. That's really large. As I mentioned yesterday on the show, anything above 1 million in something that's not, QQQ, Tesla, NVIDIA is really large. So Google, huge volume. Gold, huge volume. And not farther down on that list there, you see the other Google product, which is GOG, right? So, you can see where that volume is really concentrating. And then all the way on the right, you see the largest trades on the day. And there are just some massive dollar notionals going up in GLD, huge trades again in GDX, as I mentioned.
Wow, it's all over. Gold is dominating over here.
Yeah, exactly. And then a couple of, sizable Google trades there as well. So, you kind of have these two really big trades that are showing where the risk appetite is. And, there's this argument that, hey, with Google's narrative or ruling, that could unlock some upside in some other tech names, right, that had maybe similar type antitrust hangovers. And so maybe this sparks a little bit of rotation out of pure semis into some of these other, mega cap names. Tesla obviously doing
Tesla's up there. I know Pete's got something on Tesla for us, so that lines up. Tesla definitely showing up here in a pretty big way. Your point too, Google at 1.6 million. Kind of holding up the market here generally today.
Yeah, and that bid really faded. I mean, just to talk about what happened today, we saw the market.
Here's the intraday look. I mean, fading basically since 11 a.m.
And what was up there at 64.50, you can see those kind of ghost candles. We've been talking about this every day. There's a huge zero DTE condor trade. You can see it right there. You're hovering over it. We went up, we tagged that level, and since then there's just been a real lack of bids. We've really just been kind of drifting south. And so, I look at that opening high today as the Google kind of blow off that really lifted everything. That stuff is all kind of getting monetized. And I guess we're going to need to see not just NFP tomorrow, but we have ISM coming up as well tomorrow morning, and the NFP on Friday, excuse me. So, if those data points pass in a benign way, then vol can contract. And I think then we can kind of go back towards this 6,500 level into September OPEX. But this is admittedly a little bit softer than I think bulls would want to feel. Because if we lose that 6,400 level again, then I think we have to start refocusing on downside, particularly if there's a bad data point that's associated with it.
So the trap door opens below 64-ish. This purple haze down here supposed to be some support.
That's right. That blue purple area is support. That is positive gamma, we call that. And then you can see the other side of that short dated trade. There's a condor there. So that big condor trade that you see on the left, that's that kind of blue candle, purple candle, that goes away today. And just like on yesterday, we broke 6,400 and we hit the escape hatch, right? We went right down to 6,350. And what did people do? They sold big October S&P positions. They sold VIX calls, and they bought zero DTE calls, right? So we bid right back up. So that was a very quick response, right, to that downside. That kind of kick saved things. I don't know that kick save would come through if it's like, a poor ISM print or a bad jobs print. That addition of bad data to sort of really destroy the bullish narrative, I think, could mean that downside has a little bit more teeth. So above 6,400, I'm watching, but under 6,400, I'm probably looking to short the market and have that downside exposure.
Okay, so that's interesting. I mean, this is now going, you're saying if we start to bleed through too far, then it might be worth actually positioning for downside. Now, we talked about how the calls are cheap. Is there some room here too? I mean, VIX right now is 17, so I imagine puts can't be too expensive.
No, as we showed on that scanner grid there before, the Qs and the spiders are all the way to the left on that grid, which tells us that puts are expensive to call. So that's one feature of implied vol, right? But overall, IV is low. And so when you have low implied vol, that generally suggests that options are cheap, right? They're not that expensive to trade. And so what I like here is put spreads. We've been pitching at SpotGamma.com deep out of the money put flies, because I do think if this thing breaks, it could break violently, right? And then you could roll into this dynamic where you don't really get, a savings until September OPEX, right? So if we lose that 6,400, I start to look at like 6,175 as like the major level where this thing could exhaust. And for that, you look at 100-point wide. Deep out of the money put flies, and the S&P is very cheap at the moment, right? So there's always very interesting hedges you could put on for not very much at all. And I think that's what's really nice about this moment is like, you may want to be short the market. You can add some calls to hedge that right tail. You may still want to be in bullish mode, but downside protection at the moment is still pretty cheap. And vol will jump. As we saw yesterday, the VIX really popped strongly, right? It was around 15 and went to 1925 in a heartbeat yesterday. And so I think that's still the same dynamic where you break 6,400, that negative gamma draws dealer hedging flows to short the market. Vol all of a sudden wakes up and really starts to spike. You see the VIX head towards 20, and that's where things can get, really pretty nasty, where you start to see, 1, 2, 3% down days, in that kind of sub 6,400 area. So, that risk absolutely lurks. And again, it's pretty cheap to hedge. There's some pretty simple ways you can play, again, both tails at this moment.
Right.
And I think playing those tails is warranted.
And the last point here, Brent, is the volatility cost. Does it look more affordable at the index level than it does trying to go for some of the weaker specific names like an NVIDIA or an SMH or a Master right now?
I think so, because unless you have a single stock story or narrative, around semis or around MicroStrategy or whatever, then I think it's better to short the S&P or short the Qs if you want that downside protection, because if the market goes down, you're going to get some protection, right? You play in an individual name, you have some idiosyncratic risk, and the price of options right now in the S&P, in the NASDAQ, is pretty cheap, right? If those options were expensive, i.e. S&P or NASDAQ were expensive, and you could short NVIDIA or buy NVIDIA puts for cheaper, well, then maybe there's a reason to go and do that. But for the moment, SPY, Qs, NDX, all cheap, easy to go grab that protection and hedge out, whatever macro-ish, i.e., higher term equity risk there is. If you buy NVIDIA and it doesn't go down as much as the rest of the market, then you have that, again, idiosyncratic risk, and that's the thing I don't think you want in a hedge.
Fair enough. Fair enough. It is the one that's weakening right now, but that's kind of that's how it works, right? That's the trade-off. If you go for the stuff that already looks weak, it's going to be a little bit more costly. But usually, if Nvidia softens up, and your main trade does that as well, and the index seems like it might be behind, but we haven't broken through it yet. So 64, basically, we hope that bullish, that positive gamma supports us. Brent, thank you very much.
Exactly right. Thanks.
Great context. Mr. Brent Kochuba, SpotGamma. Nice look at the intraday levels here from the options perspective. Let's talk trading. Let's talk about finding financial freedom through investing. Of course, it's one of the big themes here in Chicago Future of Finance, and why we're doing the show here from the CBO. Part of that is I get to bring on who I want. Joel Hawthorne is one of my favorites here in Chicago. Joel, it's great to have you here.
Man, thanks for having me, Oliver.
This is a pretty cool spot because I know it means something to you too.
Absolutely.
You've been trading, for about 15 years?
Yeah,
almost?
about 15 years, man. Started as a futures trader, trading treasury futures, moving over to S&P futures, Dow. Was a prop trader for a while. Learned a ton from some really smart guys, and then took the leap and started trading for myself. So I know retail gets a bad name, but I'm a retail guy now. I love it.
That's what I love. Also, I think it's pretty cool because I think you've kind of got low-key the best lower third of anybody on the show so far. It says Chicago Trader.
Absolutely. I love it.
Because that's what it's about. I mean, this is what people believe in. It's the truth. And it seems like, especially since COVID, since a lot of people took their own finances into account.
Yeah.
A lot of people thought that was going to be a short-lived game.
Yeah.
That it was a fool's errand to try and make a living and to trade for yourself and to be profitable. But you're somebody who's done that and did it and taught yourself. You learn from people obviously here as well.
Absolutely.
But that's why I think you're a great emblem of what this city represents and what trading represents.
I couldn't agree with you more. I would have to tell you, man, as we see the AI craze, we hear everything AI everything. I think the real edge is going to come from discretionary work, right?
Okay.
And what better work than being able to be a buyer or a seller, right? Yourself, like your own money, your real skin in the game. So the way I approach it is kind of like poker, right? Like you find your edge, make sure you're not the fish at the table, and put your money where your mouth is every day. And that's kind of where it's, you mentioned COVID. COVID really opened up the door for, a lot of retail guys, a lot of smart guys too, to kind of come to the arena. And I don't think that's going anywhere anytime soon. I think that's going to be a long-lasting situation for investors and traders alike, like myself.
Yeah, I like the way you put that. Enter the arena. The other thing too is that there's a lot of people who say that they're traders, that identify as traders, but really what they do is they have a different product.
Yeah.
They sell a newsletter.
Absolutely.
I trade a little bit on the side, and I do more since we started the show. I feel like I gotta have something on.
Exactly.
But I'm a news guy, right?
Yeah.
I'm a TV guy still. But you're a trader. This is what you do.
This is what I do.
This is what you have done. It's interesting that you started in bonds as well.
Yeah.
What do you mostly gravitate towards now in terms of where you think an everyday person can find an edge?
I mean, it's fitting that we're here at SIBO Global Markets because they have some amazing products that I love. I use LiveVol every day. I use Trade Alert every day. Those two products they have.
Henry Schwartz.
Yeah, absolutely. He's a very smart guy. I mean, when you talk about using those products for looking at equities all day, looking at the option flow, I feel naked without it. I think just like today, for example, we saw Tesla, the 340 calls exploding. I think Tesla's low was right around 333 and change or something today. Those calls probably went from like $4 to $14 intraday today. Bit of a pullback now as we go into the close. But just that kind of information for retail guys is key, right? Being able to kind of see what's going on inside the market is key. And I think that, for a guy like myself, who's constantly looking for an opportunity to buy something cheap, that's what this market is about for me.
Do you have, I love that too, because you're using the tools that are here. You're watching flows. Is there a particular style? Because you mentioned poker, everybody's kind of got a style. Is there a style that you would describe your trading as, and maybe frame it this way too, because I get people watching the show and say, how do I get into this? How do I get started? Where do you think some of that lowest hanging fruit is? Is it about trying to find that high probability stuff at first to kind of build yourself a base?
Yeah. Well, I would say it's a melting pot of things. Sometimes I want to take an inventory and I want to be a seller of options. Sometimes I want to collect some premium. But there's also those days where It's fitting you had Brent on from SpotGamma. I want the gamma. I want to be able to maybe buy something with a little less lower probability, but the upside is greater.
Yeah.
So
That
I want to kind of
asymmetry,
use
that
it. Absolutely,
convexity.
absolutely. We see different days for different markets. Yesterday was a phenomenal day for that coming in after an extended weekend. We saw a lot of volume come into the market for a pullback. And then lo and behold, what happened? Like, it was a big gamma day for the buyers yesterday, right? Buying at those lows intraday. Saw a lot of people get paid yesterday if they were not afraid to kind of buy the dip. So it depends on what the market tells me. I don't really have a set rule. I think rules in trading are kind of for the novice, so to speak. How nimble can you be?
Yeah.
And more importantly, what's your pain threshold, right? Like the poker table.
Yeah.
Do you really want to fold that hand, right? Yeah. And it's going to cost you to see.
I want to make a poker analogy, but real quick too, because your background, I think this again speaks to this. You put it to me. I'm looking from our text. You put it to me that trading brought you out of the South Side trenches to the trading floor.
That's funny.
Tell me about the Chicago history and what it was like here when you started trading, and what that experience was like personally.
I'm a South Side kid, born and raised. Grew up in a very blue-collar family. Dad's a plumber. Granddad was a plumber. So my summers were spent doing real work, like real hard work. I knew I didn't want to do that, and kind of was a risk taker growing up, you know. So in that led me to kind of coming down here. I always was a pretty good student, coming down here trying to see kind of where's the money. And I'll tell you something funny. When I got a job here, I never traded in the pits. I was always upstairs on the screens. Mm-hmm. And the pit traders would come upstairs and laugh at us. They would be like, man, these guys, this is a joke. Because these guys were just crushing it. They were stars in the pit. I mean, lo and behold, though, I don't think a lot of them knew that the game was going to shift to the screens. Yeah. And so some of those guys were able to make the transition. Obviously, thanking SIBO Global Markets for kind of, you know, being very modern and their push to kind of bring this floor back here and making it very modern and technology based. But a lot of guys was just so used to the open outcry, right? And that's all they really kind of writing the cards, writing on the trading cards. It means a lot now. I mean, for me, I wouldn't do anything else. Yeah. You know, as long as trading has the discretion of being able to be on either side of the market, I don't see myself doing anything else.
When was the moment where you said, I think I could do this? I think I could trade? Because you mentioned you had a kind of risk taker's personality. What was it where you said, all right, was it the numbers? Was it the math? You said, okay, I've got the math. I could apply it here. And
great question. You know, I would have to say, man, every day it's uncomfortable. And I like it that way. Yeah. So I think every day, every single day, even today before I came here, right? It's like I was long some Tesla calls, like I said, still looking for SPX to kind of break, maybe fill the gap to the downside. So every single day, it's me saying, how uncomfortable can I be? And, you know, what's my risk tolerance? So I don't have it figured out yet.
Yeah. No, that's great. Let's do the Ask the AI here. Let's go. Show me that animation. I want to make sure Joel sees this because he's gonna love it. Tell me that doesn't look like me from the back, Joel.
It does, absolutely.
So, all right, we asked it about poker because you and I play some cards together. And full credit to you, you kind of you cleaned me out last time, but we don't need to talk about it too much.
No, not
it's all right. You hit the flop. All right, how are poker and trading similar? Both involve risk and incomplete information, but the real parallel is discipline. Risk skipping beats risk taking. Poker pros fold most hands, just like good traders cut most setups. The win isn't waiting. Behavior after losses decides survival. Tilt at the table is the same as chasing losses in markets. Both blow up bankrolls. Filtering signals is the edge. In poker, it's betting patterns. In trading, it's positioning and flows. Both reward skipping bad bets, controlling behavior after losses, focusing on signals that distort odds. It sounds like exploitation at the table. Not bad, right? What do you think about that?
Yeah, I couldn't agree more. I think that there's absolutely a lot of truth in that. You definitely want to have a bit of exploitation. You want to have the edge, right? And when you think about finding that diamond in the rough every day, a lot of traders spend more of their time, especially intraday traders, more of their time not trading. Most of your time is waiting, right? And you're waiting for that setup. You're waiting for that price. You're waiting for that edge. And as long as you're doing as long as you're patient and you're playing the premium hands in poker, right? Trading is no different.
Exactly. Love it. All right. Not going to be the last of our conversation. Great to have you, Joel. Pleasure.
Thanks for having me.
Yeah, fun to be here.
Absolutely.
Joel Hawthorne, Chicago trader. Great story. And great little eyes on today, too, because Tesla's been something we've been talking about as well. I love that everybody's eyes are on some of the same stuff. Pete Najarian's with us, a risk taker himself, of course, for the gamble. Let's do it. There we go. Easy transition from that convo. Pete, good to see you, sir. I know you were looking at some Tesla stuff too. Tell me about what you're doing today.
Well, there's been a lot of really interesting trades, and I think the Tesla trade does stand out, and I think Joel was exactly right. It was a sizable trade. I mean, when you look at the size of 8,000 of these calls getting rolled up from September, up and out actually, from September, and now going all the way out to November, that's pretty interesting. And the fact that they were selling the 295s and now they're buying the basically at the money calls at 340, that's exactly where the stock was at the time. That tells me it's somebody who's very smart, who's been very right on the direction of everything that was going on for Tesla to the upside. It was very captivating to see that one. And it makes, you always want to ride with somebody who's right? Until they're not. And once they're not, then that's okay. You just have to jump off. But that's what we oftentimes are looking at, are some of these unusual option activities like that. We also have the Burl Ives trade because they're coming after gold and silver today too. So, it's interesting to see what's going on there. And Oliver, I'll tell you, the GLD trade is one of the bigger trades that I've seen for a while. They traded 134,000 of these calls, and they were rolling up from September 320s up to the September 330s. That's a big trade. And they've been, again, this is another one where obviously they've won. They've done really, really well with this trade. And you can all you got to do is look at, well, where is gold and where was gold just 2 weeks ago, 3 weeks ago? You can see that. Silver, sort of the same thing. And silver SLV is not exactly silver. It's an ETF that was created. However, that being said, it moves very similar, just not quite with the same kind of jumps that you oftentimes will see. But they were buying all the way out to January in 2027 in these calls. So they're going out in time, but they're also looking.
Which strike was that for SLV, Pete?
The SLV, I want to say it was the 37 strike.
Right. Okay.
And then they were going all the way out to March 20 of 2026, and they bought another 8,000. So they bought 10,000 of those January 2027s, and then half as much time later, they're coming after those March with 8,000 of those calls. So really pretty active, just wanting to be there right now. Certainly, I think that's interesting to see that both gold and silver, they've had a nice move, but they've really made a nice move over the last couple of weeks. It's been pretty incredible. And I think that a lot of people have just sort of forgotten about that because there's so much focus on earnings, which makes a lot of sense, but technology, all of that. So I think it's interesting to see that we're seeing that kind of option paper trading out there for both of those different commodities.
I know a lot of people were waiting for silver for a while, so to finally see it lift off and catch up to the gold trend is making people happy. The fact that they're going further out in time, I guess, makes it look sustainable, kind of working backwards to GLD. I mean, tell me about this because, I mean, look, it seems like gold just works no matter what over the last couple of years. But you had this period of consolidation for months in the chart below 315. I got up right now and above 300. What does this breakout look like to you, Pete? And what does that come back to that GLD flow for me on telling where that could possibly go?
Yeah, well, the interesting part about that trade is the fact that they're sticking with September. Usually when we see a trade like this, they're going to go out there, but they think that this is going to happen shorter term. So I know it took a little while. I think you did a good job of defining that it was sort of stuck in a range. Now that it's broken out of the range, somebody thinks that in a fairly short time frame, this thing can still get a little bit higher. And it's right there. They're buying right at the money calls right now. So they're attacking. They want to be right there. And I'll tell you what, they've already proven to me that they've been pretty smart, whoever this trader is. And that was a massive trade to be able to get this thing accomplished. It's impressive to see that sort of size that we're seeing right now in GLD. GLD has been pretty hot for a while, but this one's interesting because, like I say, they normally like to trade the strike higher and then go out in time and buy a little bit of time. That's not what they're doing this time. They just got the higher strike. That's it.
And so time-wise, their duration is shorter for this one?
Yeah, well, this one's going to expire in September. So here we are in September. So we'll be watching this one very closely to see if gold can make that kind of a move. And it really doesn't have to make a huge move. It just has to go higher than where it is right now at 340.
Okay. All right. Love that. Tesla to come back full circle, by the way. I think it's really interesting. Maybe it was the political stuff. Maybe it was, whatever with Elon on his many different ventures. But the fact that it is a very uncorrelated chart to tech and to the market itself makes it a very fun trade. And the fact today it's up alongside gold, I think speaks to that discorrelation, if you will, the way it's uncorrelated from some of the other stuff. What were they buying in that one, Pete?
They were buying the November 340 calls, and that's rolling up from the
340.
September 295 calls. So imagine that. They've had this run from those Septembers, which were give or take, call it at the money at the time, and they're actually going all the way up now to 340. So they're taking a huge profit, putting a lot of that money in their pocket, but actually looking for even more into the future. So I like this trade. This is more of a standard trade where you are buying time. So they're going from September, but they're going all the way out to November. So they are buying that extra couple of months, looking for this thing to make that kind of a move. I think that makes a lot more sense with Tesla, and I don't think it was not a foolish move on GLD the way they were doing it, because the move right now is there right now in gold. Gold has been powering forward now session after session, and I think that's probably the thinking behind that trade. But Tesla, you always want to have a little bit of time for this thing to make those moves. If you got enough time, it really can be incredibly profitable. But let's not forget, these are very expensive options. These are stocks that are trading, in the 300 plus area. So those things start to get kind of expensive.
Yeah. It's a hefty lever you got to move. Hey, let's do some gambling here, Pete. Let's go back into my screen. Let's go to Kalshi. I got something on politics. You got something on sports. Which cities will Trump send the National Guard to this year? I hate to say it. Well, I don't know. Look, you could argue both ways. Chicago right now is at 74%. New York City at 37%. I feel like New York City is a sell. I don't even know how you fit anybody else into New York City already. Chicago, if you put them in the right neighborhoods, honestly, I wouldn't hate it. But
Right. Yeah, it sure is interesting, isn't it? I think it makes sense. Like it or not like it, I think that Chicago makes a lot of sense. There's still, I know that it popped and then it's come back a little bit. And obviously during the pandemic, we had that huge pop. But I think that what the president's looking at and what people are looking at when they're betting on this is just that the fact that there still is lots of crime. Even if it's dropped a little bit, there still is plenty of crime going on. It's not like it ended and we can actually do a victory lap. Anybody who wants to do a victory lap right now would be a fool. I think
537 homicides last year. It's the most in the nation. 15 years we've been holding that record. So, and by the way, I would argue that there's a nominal versus rate. So Pritzker talks about the rate, but the nominal value, I mean, these are lives, obviously, and I don't want to get too off track, but I think cities, too, there's a convexity to safety in cities. When you get to a certain size, it should sort of create safety on its own. So our numbers way off from New York, way off from L.A., So, all right, but hey, maybe I think you sell New York here, and maybe Chicago's fairly valued at 74. Let's talk sports, the stuff I don't know, because Mahomes and KC at 61% versus Rams. What do you think?
Yeah, it makes a little bit of sense, and I think a lot of people are concerned about the age difference right now. And it's not that Mahomes isn't a young man; he's getting a little bit more middle-aged for a quarterback. And so when I look at that and I see what Stafford's doing too, Stafford's one of the oldest quarterbacks. He's not the oldest. Obviously, Aaron Rodgers has got that little bit of a beautiful part of his world. But I think when you look at this and you look at Stafford's a great quarterback. He's had some great seasons and the big trade, obviously, with Detroit and all the success that he's had out there in LA. But I'll tell you what, I do think it's going to be Kansas City is going to run on them pretty good. I mean, I think that's a really good team. Really well coached. They've got all the players that they'd like to have. Can they get to the Super Bowl? They certainly can. But I think that there's going to be a lot more folks in front of them than they saw the last couple of years as they got closer and closer, got into the playoffs, and then get to the Super Bowl.
All right. Well, hey, 39 cents, not bad on 61 if you're right. So seems like market's got some faith in the young guys in LA. Appreciate it, Pete. Fun.
All right, man. Take care.
You got it. All right, great stuff. Pete Najarian, co-founder at Market Rebellion. All right, clean slate. We're coming back. We're going to get real mathematical with Petra, Bakosova, whole tactical next. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. SIBO is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from SIBO, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to Chicago, Future of Finance. Let's talk numbers, let's talk ETFs, and a lot of growth here in Chicago's quantitative models. Petra Bakosova is the CEO and manager of the whole tactical US ETF. And great to see you again, Petra. Thanks for coming in.
It's good to see you, Oliver. I love this new location. This is very exciting.
We met in my last gig kind of early on when I first came to Chicago.
Yeah.
And I think it's an amazing trajectory that you've been on, because one of the things about the show I wanted to do was realize, that we're always talking markets.
Yes.
But in the time that I've known you, guys' fund, H2US, which just celebrated its 10th year,
yes,
also crossed 100 million around the same time.
That's correct. And I think you sort of have been along for the ride for our entire trajectory. I think when we first started talking, we probably had a 6-month model. Maybe we were toying with some 1-month models. And now we have put so much effort and new models into the ETF. We're really pushing the boundaries of what can be done and is done in an ETF wrapper.
That's why I love this conversation, because when I've got this show, but I've also tried to build my own business. I've been working more in the pipes of finance. I've worked with advisors and product managers, and I realize how hard it is now to get to $100 million, especially when you have a fund that's using options, that's using a quantitative model, that a lot of people are trying to go after that market. So what's kind of the secret sauce that you think has been a winning sell for this fund?
I would say our secret sauce is like not having a secret sauce in a traditional sense. Like, we're not trying to do anything that's, we're not going after any really expensive data sources. Like, our premise is you can use public information that's out there, and you can, through a careful quantitative analysis, you can combine small edges, and we call these small edges micro alphas. We wrote a paper called Micro Alphas, and our thesis is you can combine these micro alphas in a smart way and use machine learning and AI to do smart modeling and produce a small but consistent edge for your investors. And over the long run, over 10, 20, 30 years, these small edges accumulate and it create a meaningful advantage.
You're a 5-star fund on Morningstar. Tell me about how you frame the goal. Is it to beat to the upside? Is it to lose less to the downside? Is it to do both at the same time? Because a lot of what I see using options in particular is funds that target reduced downside, but then they kind of lag a little bit to the upside. What's the main goal, and how do you think about it in that simple framing?
Yes, I wouldn't say we're trying to be some kind of a tail risk hedge. We don't want to give up the upside. And so what we're shooting for is almost like a stackable portable alpha type of a fund that on average we will be 100% invested in the S&P 500. We think the S&P 500 over a long run, really hard to beat, should be a core component of everybody's portfolio. But we're trying to add these overlays, whether it's the market timing overlay, if you will, or these options overlays on top of the S&P 500. So when our signals are bearish, we will be less than 100% invested. When our signals are bullish, we will be more than 100% invested. And then hopefully we create both upside and downside capture advantage for the clients.
You've talked about your market sentiment meter that you use. To your point, you look at public information, look at things like PMIs. You just caught me up to speed that right now that's at like an 87% positive reading, or how do we interpret that?
Correct. So like today we're 87% invested in the market. So that means we're not very bearish, but we're bearish. So anything less than 100% for us,
Anything
a little
less,
bit
okay.
bearish.
How much do you go to the upside?
We could go all the way up to 200% long,
I see.
and we could
Okay.
go flat.
Okay, and will you typically use options for that, or how do you achieve extra upside the same way that you hedge downside?
Oh, we have a wide variety of asset classes at our disposal.
Okay.
We can invest in the SPY, ETF, E-mini futures. We will acquire a certain portion of our deltas, long deltas, through SPX options or XSP options. We have the ability to trade VIX futures as well. So it really is, we look at which products are most overpriced, underpriced. We look at where people are, creating some market dislocation through excess buying, excess selling, and then we accumulate the position where we think is the most advantageous.
Are there any particular products that you find yourself using more of or more frequently than, say, a few years back? And I'll kind of prime the question with a few examples of guests we've had on. A lot of people using flex options,
Yes.
but a lot of that's kind of coming from the buffered side, kind of fixed items. Obviously, we talk a lot about zero DTEs. So there's a few in there.
Yes, no flex options.
Okay.
We sort of tend to be, interestingly
Too
enough,
expensive or what?
we
It's
think
not for your style?
we think market makers love them, and when market makers love something, we probably don't love it so much. So we're staying away from those, and we also tend to be on the other side of the buffer ETFs, if you will.
Right.
Like the buffered ETFs tend to serve, I would say certain fears of investors. People are looking for tail risk protection, are defensive, want to or are willing to give up upside, and we're sort of saying we're being really rational, systematic, disciplined. So we're probably going to be on the other side of some of these trades.
Okay.
We did embrace zero DTEs. We do have zero DTEs. Especially, we saw a huge flow of retail traders going into the zero DTE market, which we felt created a lot of opportunities for us. So we are in zero DTEs.
Now, do you find, not exactly the market makers. Now, do you find that you're usually using those to bet against bigger moves? Are you kind of taking the more short gamma side while people are trying to catch these big inflection points where more often they're going to miss those than hit them?
We are actually both. We're not just selling them, or we're not just shorting strangles in the zero DTEs. Depending on what our models tell us, we can be both long and short.
Okay. Thinking about how your background, you study mathematics on an extremely high level at University of Chicago. Tell me about that and kind of how that informed. And also, Blair Hull was he's a former blackjack guy, right?
Yes.
Where do you guys find that kind of middle ground? We were talking with Joel earlier about poker. We're poker players.
Yes.
And the real kind of obsessive math people are blackjack people because they're willing to take on a very almost non-existent edge.
Yes.
So how do you kind of combine the very quantitative pure math side with that kind of background of the speculator?
I actually think they blend very nicely. I would say there's certain lessons that Blair learned at a blackjack table that we sort of adopted and integrated into our investment process. So one would be bet often.
Okay.
So as you said, the blackjack players, they will take the tiniest advantage and then they will play, 100 hands an hour for 8 hours a day, do it 50 weeks in a row, and then
so hard that even Bill Gross got booted.
Exactly.
Had to give it up.
So we do believe that, and that's partially why we shortened some of our forecasting frequencies. We went from a 6-month model to a daily model. We're trying to see if we can find edges on the intraday basis. So we try to bet more often, and then just like the blackjack players bet proportionally to their advantage. That's what we do. All we try to do is how confident our models are that we should be bullish or bearish, and we always try to scale our bets proportional to the size of the perceived advantage that we have.
Yeah.
And last but not least, stay in the game.
Okay.
Don't blow up.
Right.
So risk management.
That's exactly what the AI was telling us when we looked at that too, is the importance of not tilt, not blow up. So the point about knowing when you have an advantage, and I don't know how easy this is to answer without understanding how your algo works, but I think for a lot of people it's a really important point. What are the signs that you have an edge? What are the signs that, okay, this is when I do want to apply leverage? Is there a way to think about that simply for kind of the everyday person?
I would say this is, the $1 million question. So what we do all day long, we have a group of 15 quants that, look at data and derive features from the data and build models and build backtests. And then we deploy the good looking models into production. Then we trade, and we have a traded performance, and we accumulate realized returns. And these accumulate kind of slowly. And it's really hard to tell the difference between like when your model is going through like a temporary period of drawdown versus when your model was overfit in the first place. So I think sadly, there is not a simple yes or no, I have an edge and this is how big my edge is. It's really hard to measure. And you just try to be as quantitative as in your back testing process as you can, and try to eliminate overfitting and forward-looking bias and all the different mathematical errors.
That's where poker is easy, because you just pay for a GTO model and tell you if you did the right thing or not, or the math is confined. Now, to that point, though, is when you think about AI, where is there an ability to insert that in? And has any of your kind of modeling been able to be replaced, supplanted, augmented by AI? And how should folks be thinking about that and understanding your own approach?
I would say I like the word augmented.
Okay.
So we don't use AI to replace our investment decision making. We use it, I would say, two ways. Like one is that's already being in place. Just kind of like looking for suggestion, new indicators, maybe critiquing our model, critiquing our approach. That's been really interesting.
Okay.
And then second, one of the cool thing that I'm really excited that we're about to do, we're just weeks of launching our own Kaggle competition. I don't know if your viewers are all familiar with what Kaggle is. It's a data science platform run by Google, where basically thousands of data scientists from around the world compete at predictive models. So we basically are sharing our data set with Kaggle.
Very cool.
We're asking thousands of data scientists around the world, like, give us your best model for prediction of next day's equity risk premium.
Nice.
And we're gonna find out what they can come up with.
Very cool.
Yeah.
Petra, great conversation. Love the details, love the insight, catching us up to speed on the model and markets. Appreciate it very much.
Oh, thank you so much for having me.
Absolutely.
It's good to be back.
Stuff. Very cool.
Yeah.
And congrats on the huge growth in the fund as well. HTUS is the ticker, the whole tactical. Petra Bakosova, CEO and fund manager. Coming up, let's go to the risk radar. Let's talk about gold, which has been pretty far out on green for a while. I don't have an algo for it. The chart just always looked good. It seemed to work no matter what. There it is. Maybe it should have been fully out on the green, but it's been green throughout the duration of this graphic and this style. So the other things haven't changed. The dollar I mentioned yesterday, that's back down again after firming up. Bonds still bouncing around. So the range-bound nature of the macro hasn't changed at all. Stocks still green as well, even with a little pullback here. If NVIDIA softens up more, if chips break, maybe I'll reconsider for that. And Bitcoin there with cryptos drifting into the red, but not yet. Still yellow after putting up a fight here in the last 24 hours of MicroStrategy, and Bitcoin firming up a little bit here today. Well, not Master, but Bitcoin did. Coach Scott Bauer with us from Prosper Trading Academy to critique the radar and talk some gold. Scott, I mean, the number one thing that stands out to me today is gold. The reason it's been green on my radar forever is because it seems to work in any environment. I don't know how to describe this environment right now that we're in, but gold seems to be working in it too.
Yeah, for sure. Risk on, risk off. It has not mattered for the last 6, 9, 12 months. And the way that we have approached it, and we have been in and out of the GLD trade the entire year. I think we've actually here at Prosper, I want to say we've had over a dozen trades on. This has been the ultimate buy the dip. There is no question about it. For whatever the fundamental reasons are, and there's definitely a disconnect from the way gold is trading to how it historically trades in relation to interest rates and geopolitical concerns, blah, 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 blah. This has been the ultimate buy the dip. Now, full transparency, we were in another long position, which we exited out of last Friday. Obviously, if we would have held it through the weekend and at least got the move yesterday, it would have been even that much better. It was still a monster trade. So this is a situation, Oliver, where sure, you can look at all the charts you want. You can be the most savvy, fundamental, disciple of gold. It doesn't matter. It doesn't matter right now. This is buy the dip until it's not.
Yeah.
So, if we look, if you pull up a GLD,
Yeah, we're
chart,
on it. Yeah,
okay?
we're at 328 right
Okay.
now.
Exactly. So for me, what would be the next buy the dip? Well, it's probably this gap that happened from the weekend to the open yesterday. So I'd be looking at probably the 318 area in GLD. Now,
Okay.
that's $10 away. It seems like a lot, but man, we were just there,
Right.
2 days ago or yesterday. So that would be an area I definitely have an alert set that I would take another long position there. That is the buy the dip. I mean, this has been, honestly, it's been flat out the best trade of the year.
Yeah, the 318 basically where it kept getting rejected from. I just put a line there to show where the bottom of that gap is. And that I was kind of thinking the same thing too, because technically my new risk radar has got different spectrums of color. And there's like bullish and then uber bullish, and technically gold is bullish. So I was thinking today, like, all right, when would I get super bullish on gold? And I think you just answered my question, which would be if it pulled back into 318, then you gotta, love to take a stab at the old resistance turning into new support. Do you think there's any macro message in this, Scott? Because I'm not a big believer that gold is pure risk off. It's somewhere in between. It's like a hybrid. It might tell us there's more risk off coming.
Right. I would say for the last year, it's hybrid. There's nobody that can prove to me that this has been a safe haven or a risk off trade over the last year. Like I said, historically, it's relationship with rates, it's relationship with the dollar, it's relationship, with macro headlines. Nothing matters. Nothing matters. You go back in gold, and again, I'm gonna just focus in on GLD here. You go back to basically last December.
Okay.
When GLD was 240-ish or so, and if you look at that chart, you made money on every single pullback.
Wow, it's a straight line. It's crazy.
It's crazy. And again, at some point, it's going to stop. At some point, it's going to become so overbought that we probably will see a significant pullback. But using options, every time I put a trade on, I know what my risk is. So if we get to that point and it doesn't work out at that point, okay, great. So I would have, the one losing trade out of the other 15 that we've killed it so far this year. But again, if you want to trade gold based on fundamentals here, you might as well just not trade it.
Do you feel the same about SLV and silver? And I'm going to start with the 2-year chart because the comparison there is a lot more chop throughout the last couple of years. But if we come back and zoom in, I mean, I know that a lot of people have been waiting for this to catch up. And Pete was pointing out earlier some call buying with some pretty strong conviction. This one, to me, is always trickier. It feels like anytime I've tried to get into silver, I've mistimed it, and I just regret not putting that money into gold.
Totally. And I think we've taken, honestly, this year, 2 SLV trades. Sure, it has the same kind of trajectory as GLD, but I wouldn't say it has been as consistent. You're right. It's been a lot choppier if you look at it. So sure, if you put up a 50-day moving average, if you can on there, you can see that over the last 6 months, that has flat out been a signal to buy on the 50-day moving average, including the last time it hit there, which was about 3 weeks ago on the 19th of August. It was down at 34, and here we are, 10% higher. But it has been a trickier trade than GLD.
For sure. Okay, speaking of tricky, let's go brass tacks here. Let's talk stocks. I don't want to like make a big deal out of nothing. And, I just feel like just by saying that, I kind of am. But I'm a little bit surprised there wasn't a better bounce back today in NVIDIA or the chips. NVIDIA down 40 bips. SMH actually coming back to almost even. That's not bad. So I guess we did buy the dip on that earlier today.
This is a tough one because if we look again historically at these cycles and at the sell in May and go away and the September effect and the January effect and all those cycles where over time there has been a really strong pattern of how the market has reacted. Well, 2025, we haven't seen that. The first one, obviously, the big dip in April, nobody expected that. Great comeback. But if you look at the sell in May and go away, if you did that, you got clobbered. And there were a couple other times like that where historical trends would have said, the market's going to sell off, and we didn't. I'm not going to say that we're going to end September higher because we know that September historically is the worst performing month of the year. But given these trends that have been broken this year and how the market has defied, whether good, bad, or indifferent, how the market has defied everything that's been thrown at it, you can't count it out that we're going to end this month higher. And the bottom line for me is, Oliver, and you've heard me say this, and I preach it to all my students all the time, is you want to stay long in the equity markets? Great, do so. But buy that protection when you can. Now, the VIX, it's down, 70 bips today. So historically, it's pretty cheap. It's not as cheap as it was a week, 2-3 weeks ago, right? But it's those opportunities when you get to buy that cheap insurance that allows you to stay long in the market. And you hope when you buy that cheap insurance that you don't ever have to use it, right? And so you give back a teeny little bit of what your upside potential would have been. Great, fine, that's good by me. So I think we're still in that zone here that, I would cautiously stay overall long in the markets, but you got to have some downside.
Let me ask you this, Scott. I'm always tempted by the betting on just a big move. I'm always kind of tempted by the long straddle or strangle, depending on how you want to do it. And a lot of times those are expensive trades that are essentially kind of timing trades. But connecting it with the top of the show, because Brent Kochuba was talking to us about how cheap calls are too. I mean, I wondered if that kind of spidey sense I've got in the market, maybe this gold thing is just we're getting a big move coming no matter what. Give me a 60-second thought. Do those trades suck or are they decent sometimes?
No, they don't suck. And you're right about calls being expensive. If you look at the skew in the S&Ps and the ES, wherever it is right now, it is massive. Where like 10% out of the money puts are so much more expensive than 10% out of the money calls.
Exactly.
I love trading strangle swaps. What does that mean? It means I will sell a near-term strangle, whether it's this week, a week out, 2 weeks out, and buy one further out. So I always want to have that protection. I don't have as big of an outlay of just buying that expensive strangle. So I like to do those swaps when volatility rises.
It's like a calendar swap. I mean, a calendar strangle.
It is. It's a calendar put spread and a calendar call spread. In fact, I have 3 of those on right now. Salesforce, which has earnings right now, coming out any minute. DocuSign, which has earnings coming out tomorrow. And ZS, which we had one going into earnings yesterday, which we did real well on. So I love those scenarios.
All right, there we go. I think we found some. Hey, S&P's pushed until the close, by the way.
They did. So they did. They were about to turn negative, and what are we, 18 higher, 18, 19 higher?
Yeah, almost broke it even on the day, 64.51.
Oh, nice. There we go. Yeah, 64.50.
Yeah. Nice little ramp there. There you did it, Scott. You ramped us up.
Hey, you know what? People have to tune in and always have that protection there, right?
Exactly. Appreciate it, Mr. Bauer. Nice, cool. Like the trades, the strangle swaps, finding a way to take my losing habits and make them a little more profitable. There's our lesson for the day. I think that was the intersection through all our combos. Appreciate it, Scott, CEO of Prosper Trading Academy. Thank you for tuning in to Chicago Future of Finance. I will see you tomorrow. Another banger on the way at 2 p.m. Central Time.